getting impacted by customers trying to refocus or reprioritize their spend and taking calls on their discretionary project and reprioritize them into cost and optimization projects. And what that has led to is the existing revenue base is getting impacted through project pauses or a deferment of or an enhancement of the spend, which is offsetting the incremental growth coming in from the deal side. If you look at it, this is something which started since January of the calendar year and has been continuing through. If I look at the last 6 months per se, what we have seen in Q1 of April, May, and June, and what we have seen in Q2 on a month-on-month basis, the trends have been similar and have been continuing. So if we look at from a near-term perspective or the next 2 quarters perspective, the current trends which we see are very similar and trends seem to be continuing. We expect, as you rightly pointed out as well, normal seasonality in Q3 and Q4, whether it is in terms of the working days or in terms of holidays or some amount of furloughs which we usually see. So the stance which we have been taking is taking a month-on-month approach and staying close to our customers and taking it 1 month at a time. Coming to FY25, I think it will really depend on how FY24 pans out, the exit rate which we are able to get in FY24. And structurally, if you look at the deal wins, does provide a good headroom in terms of what we can deliver and what is the backlog which is available. What we need to see is how much of the current macro uncertainties carry on into FY25.
Since you mentioned exit rate, one report I read this morning said that you could end FY24 at maybe 5-6%, but FY25 they expect you to bounce back to double-digit growth. I think 11 to 12%, with 2.5% coming from the BSNL deal itself. Would that be a fair estimate?
Well, what I said, what I explained you, we'll have to look at FY25 how it pans out. While the deal wins do provide the positive cover in terms of overall stuff, we'll have to wait and watch how the macros pan out and how long they get stretched and how big an impact it has in the coming months.
Right. Deepangana?
Yeah. Samir, just to start with, yesterday there was a very good improvement in terms of margin, 110 basis point improvement. And you had also alluded to the fact that your aspirational target for the margins is in the range of 26 to 28%. So want to understand, do you expect this improvement in margins to continue in the upcoming quarters as well? And so also any timeline for that achieving that target?
So first, let me tell you, 26 to 28 is not just an aspirational band. We, all of us collectively at TCS, firmly believe with our long-term cost structures, we can definitely operate in the 26 to 28% band. And that is something which we are collectively focused. And the measures which you have seen in Q2 are some which we can expect will help us get to 26 to 28. So coming to the 110 basis points which we were able to deliver in Q2, if I were to break it up, and that would tell us also the levers which are available in the future. So 100 basis points was delivered through disciplined execution, and by that it is primarily driving productivity, utilization, and further optimization of the subcontractor costs which we have. Also, if you recall, last quarter I had called out that some of the discretionary expenses have started gathering critical mass, and we have been able to drive 35 basis points of our margins from driving efficiencies in discretionary expenses. While both of these have happened, we continue to invest into our infrastructure. So investments where required are continuing at its pace. if we look at can we are these levers further available to double down upon, we do believe that productivity, utilization are some things where there is further scope of optimization. And if growth continues where it is, we can definitely double down on our subcontractor costs also, because that's more of flex capacity.
Got it.
Any
Yeah,
any
continue.
timelines yeah, any timeline set for the margin target of 26 to 28%?
So if we continue to double down on our levers, and if growth comes back in, it will only help us accelerate this journey.
Sure.
But we are all working towards getting into 26 sooner rather than later.
Got it. Samir, taking off from Vibhangana's question on your margins, factors like productivity improvement, utilization, helped you this quarter. But in terms of the coming quarter, will we see this variable pay getting absorbed, and the fact that you're asking people to come back to office 5 days a week? How will that impact your facility management costs? Because I think facility expenses, the fact that it came down during COVID for all companies, was a major tailwind. So these two factors, how will it impact your margins?
Okay, so first, if we look at it from a QVA perspective, we there isn't any change between the quarters. We have given 100% QVA to 70% or more of our employees, and balance is always basis the performance of the business unit and overall company's performance. Secondly, if we look at it from the facility expenses perspective, one key thing is when the pandemic began, we did not give away any of our facilities. And whatever were the in-flight projects as well, we continued to invest into it, probably at a little slower pace, but the investments or the activities of building up those facilities progressed. So if you look at it, the differences in terms of the operational costs at the facilities in terms of electricity and the maintenance part of it, mainly electricity, which might inch up with return to office, but that's not significant. If you look at so we continue to invest incrementally, and while overall expenses might go up, but that is in line with the revenue stuff also, we don't expect any significant impact on margins because of return to office.
Dibangana?
Yeah, I also wanted to touch upon, a lot of the improvement in the margin also came from improving your utilization rate. So, to that extent, is TCS looking to reassess the hiring strategy, and also what kind of an impact did this utilization rate improvement bring on the margin?
Okay, so in this quarter, a combination of factors is 100 basis points. We don't specifically call out the utilization, but I can definitely tell you utilization still has considerable scope for further optimization. And the reason why this comes up is if you look at during the pandemic quarter, when there was the entire supply side challenges going on, and there was a merry-go-round going on in terms of everyone hiring each other's talent pool, we took the call of hiring freshers, the trainee graduates at scale, and we build it into the capacity. And if we look at that capacity is getting into the productive pool, and that is where our requirements of hiring incrementally in its form right now is balanced, and that is what is helping on the utilization front as well.
Got it. Samir, I also want to understand in terms of, the overall macro environment. Currently, at least, it's more of these cost optimization projects that are coming on stream, discretionary spend, particularly, in your mainstay BFSI, that is still not firing as much. But how are the client conversations evolving? There was already this uncertainty about US, and then this Ukraine compounded it. Now you have the Israel factor, the West Asia war, and its impact on global economy. Has that also come up in conversations with clients? Are they delaying decisions because of another geopolitical factor weighing in?
I think the overall hang of macro continues into it. What we have been doing is staying close to our customers, looking at what their agendas are, what their reprioritization initiatives which they are taking into consideration, and helping them drive those agendas. There are customers who are doubling down upon their transformation spends, and we are staying close and helping them out. The other customers who want actually to relook at their current spend and double down on cost optimization, and probably first get the cost optimization or cost takeouts locked in, which will help them fund their transformation. So it's a mixed bag in terms of how customers are taking it. While the overall discretionary thing is broad based, individually what customers are taking in terms of whether they want to prioritize transformation first and then look at other initiatives, or get cost takeouts done before, which will help them fund the transformation, are a varied call across customers.
Dibangana?
Got it. So I also wanted to understand, there has been a new internal restructuring within the company. So how is it going to help with the overall scheme of things in terms of driving the business?
So the restructuring which has been done keeping the customer centricity in mind. So after Kriti took over, he spoke and met a lot of stakeholders internally and externally, and the feedback from the customer was that while the model is great in terms of the existing one, the customer focus or the industry focus seems to have got lost. So what has been done is flipping over the structure, making industry vertical the primary focus, and that brings in the industry expertise in the forefront and gives the better comfort to customers in terms of what they look at it as the USP of TCS.
Chanda?
Samir, one of the strongest indicators of growth for IT companies has typically been headcount addition. I know Milind said that's not the way we should, look at it. We should look at other factors also. But, it is the pace at which you're hiring or planning to hire. And in TCS's case, your headcount addition has come down by 6,000 people. The gap between attrition and headcount addition, I think, is narrowing. So when can we expect TCS to hire, not in large numbers but in medium numbers? Because I think campus hiring this year also has not been robust. So while you are taking up utilization, improving internal utilization resources, bringing down subcontracting, when can we expect fresher hiring to go up?
So, couple of points. So first, if you look at when we were hiring at scale, the question was, why are you hiring at scale when the revenue isn't visible, right? Because hiring is a long cycle one, and we have not stopped hiring. We continue to hire. We continue to hire laterals. We continue to hire trainees. Just that in this quarter, the amount of hiring which we have done is lower than the amount of exits or the number of people which we have lost. Second, in terms of, if you look at it, what I explained before, the amount of trainees which we have hired at scale getting into the productive capacity is taking care of the requirements which we have on the demand side. And we always calibrate our hiring with a longer term call taken in terms of what the business demands are. And we have not stopped hiring.
Got it. Bangna?
Yeah, so I wanted to understand more on the generative AI side of things. So yesterday it was very clear that AI customers are looking at generative AI to drive cost efficiency and optimizations. So, but it's also being said that these deals, because it's talking about cost optimization, would eventually the deal sizes will be smaller. So wanted to understand how is TCS, how are you looking at it?
Okay, so if you look at it right now, also the it's in the very preliminary stage in terms of the deals on Gen AI. While what we have seen is the structuring or the quality of deals are getting more matured, and in some cases, as part of large transformation deals, Gen AI is getting inbuilt in certain parts of the overall program, or certain activities being influenced by Gen AI. What we have been doing is we have been doing a lot of co-innovation with our customers on Gen AI capabilities. We have been doing a lot of pilots and use cases with our customers, and also helping them build their Gen AI strategy or roadmap towards it. And towards that, we have already started investing on it. We have 100,000 plus employees who are genuinely trained. It's foundational training, and that builds the foundational part in terms of path, in terms of getting the Gen AI capabilities organically available.
But are you expecting deal sizes to go down because each deal is looking at adding this Gen AI element to it, which is more focused on cost optimization at the moment?
So, Demagna, if you look at it, productivity is always part of outsourcing, and how we can deliver better value to our customers. Gen AI is one way of delivering productivity.
Got it. Just one last question from my end, Samir, on the pricing environment. Again, does that depend on whether this is a Gen AI project, whether it's a cost takeout project, whether it's a discretionary project? If you can give us a sense of how the pricing environment is.
In general, there are a few layers which get built into the pricing thing. But to say in its form, pricing currently is stable. Pricing depends on whether it is what are the services being delivered is one component of it. There would be differentials in pricing the heritage services versus the new age services. There would be difference in terms of how the deal is being bid by the customer. If it is competitively bid versus a sole source deal, there would be pricing differences. And also it would depend on the so more than the pricing, how much of capabilities you can put it forward, and how much of value addition which you can show to the customer is what our focus is, to create it as a win-win for us as well as our customers.
Got it. Any other questions?
I think that's pretty much it. But if you would want to shed some light on this new TCV guidance that TCS announced yesterday, that's going to be in the range of $9 to $10 billion. So what's driving that confidence for the upcoming quarters?
The last 3 quarters having delivered 10 plus billion. I think, if the revenues are at, if it will take a book to bill, if you can get a book to bill of above 1 and in the range of at least 1.2 to 1.4 is a decent deal win to have.
Sure.
Got it. Got it. So hopefully, Samir, we will see, this conversion to revenues also improving along with TCV, which I think was a pain point. But on that note, thank you very much for talking to Moneycontrol on the quarter that was, and more importantly, the outlook ahead, not just for the rest of the year, but for the next financial year as well. Thank you for talking to us.
Thank you, Chandra and
Thank you so much
Devangana.
for joining.
Pleasure speaking to you.